Okay, I'm back. All right. In this webinar, we're going to talk about a lot of things, including the housing market trend in October, because we are just in the beginning of November. In the past month, everything changed. I'm not sure if you guys have noticed, but the market is not what it was yesterday or the previous months. It's a very different market right now. Very different. We're going to go through that. And then we're going to talk about Australia's economic fundamentals, global economic fundamentals, key observations in the market. And then in the end of the webinar, I'm going to give you guys about 10 minutes to ask your question, but it doesn't matter. You guys can ask me any questions anytime by typing your questions in the chat box. And then if I see it, I'll answer the question in the middle of the webinar. All right. So for those of you who don't know who I am, I'm the founder of Australian Property Strategy, and I've got a Chinese equivalent called AFC. It's Chinese language, don't worry about it. And I also have a YouTube channel with roughly 350,000 followers talking about personal finance, the economy, and how to get rich by investing. So that's the English side, and we call it overseas side, as in from a Chinese point of view, overseas is everywhere except for China. So within China, I've got a follower for about 1.2 million. Last time I checked. So in total, my followers on the web, I think it's about 1.6 million right now. It was more than last time I checked. Yeah. Anyway, and I started this company called Australian Property Strategy to help anyone who wants to change their current wealth status and then climb up the wealth ladder and change their life. Well, no one wants to work 9 to 5, right? Unless you like the job. But as far as I know, most people don't like what they do in the office. So investment is actually the only way, probably the only way to get out of the rat race. So that's why I started this company called Australian Property Strategy to help ordinary people to invest in Australian property, to get rich, not get rich quick. No, not that, not like that, nothing like that, but to get rich a bit quicker than other people, right? Okay, we'll get to that. Now, before we start the webinar, there's a quick disclaimer. Whatever you hear today is actually verified by our company. Well, it is verified by our company, but it could be wrong. It still could be wrong. We did our best. So this webinar may include some tax advices, financial advices, and all that kind of things, but please don't make any decision or make any move, including buying a property, selling a property, or renting a property, or do anything or not to do anything just because you watched my webinar. All right, you've got to take responsibility of your own actions. Right? Okay. All right, let's get started. While we are doing this webinar, if you guys have any questions, just type your questions in the chat box and I will answer that. All right, so first of all, by the way, I'm doing this webinar for those of you who just came in. I'm doing this webinar on Zoom as well as on YouTube. So let's see. I'm trying this for first time on YouTube. Let's see how it goes. All right, Australian Property Index increased by actually 1.1% in October. And it's been on the upward trend for 9 consecutive months. So as you can see, I've got the data from Cotality. It used to be called CoreLogic. I still like the old name, but anyway. In October, the national price went up by 1.1%, Sydney by 0.7%, and the median property price in Sydney is 1.25 million. But the last time I checked, the median house price in Sydney was about 1.7, maybe 1.65. Forgot. Anyway, in Melbourne, the overall price in Melbourne went up by 0.9%. It's officially surpassed Sydney's property market growth speed. That's a big surprise, very big surprise. From memory, in September, the price went up in Melbourne by 0.5%. It didn't break my standard. My standard is that if a single city's property value growth or decline rate is between plus minus 0.5%, I consider that as a flat period, a flat phase. But Melbourne just broke it up to 0.9%, which was a huge surprise. So I think it's time to buy. Otherwise, it's going to be too late. In the last 6 months, I was kind of not sure. I wasn't sure about Melbourne. I knew it was going to go up, but I wasn't sure when. And now I'm pretty sure. It's going up. Brisbane, October property market price went up by 1.8%. It's almost leading the entire nation, but it's behind Perth, which was 1.9%, just by 0.1%. So Perth was number 1 last month. Then it's Brisbane. Then it's Adelaide. It's up by 1.4%. Darwin, 1.6%. Hobart 0.3%, and Canberra 0.6%. So if you look at the median value, Sydney is still number 1, and the second is Brisbane. Median price is 992,000. After that, which one is it? It's Perth. Is it Perth? Oh no, it is Perth. Number 3 is Perth. Number 4, Melbourne. Number 5, Canberra. Okay. All right. This is the 8 cities property price movement. We actually did this chart in 2022. We've been following the whole market and every single city in Australia for the last 3 years. And we did this chart because at the time I wanted to track each city's monthly growth, but I couldn't find any research on that, so I did it for myself. And then it was getting more popular. Everyone wanted a copy of it, so I just decided to put it out publicly. I put it on my website. So if you go to my website, propertystrategy.com, you will see this chart. You can monitor the trend of Australia's property market and as well as the property market trend in each city in Australia. All right, let's take a look at the details. The 8 cities property price movement. This is Australian property market. It's been up for 9 months, and the trend is accelerating. See that? Last month it went up by 1.1%. Sydney was in pretty much the not exactly the same, but very similar trend. But the growth rate went down a little bit last month. It used to be 0.8%. Last month it was 0.7%. Okay, it's losing a little bit energy in the market from the data. And Melbourne is actually a surprise. It went up more than Sydney last month. So if you are still wondering if you should buy any property in Melbourne, now you get the answer. You should. Well, despite the high land tax and all kinds of taxes that the state government of Melbourne, state government of Victoria wanted to increase, or they wanted to create some new taxes all the time. But obviously, the investors don't care anymore. All right, these three are the mid-sized cities. That's Brisbane, Adelaide, Perth. They're all on the upward trend, and it's getting crazy. The trend is getting crazy. Brisbane went up by 1.8. This is 1.9 for Perth, and Adelaide 1.4. So, should you buy? Should you still buy? Well, for example, Perth. I talk about this in every webinar for the last probably 12 months. People always ask me, "Hey, Alex, is this still a good time to buy in Perth?" They asked me the question here. That was back in Q1 2023, when Perth property market just took off. They asked me the question. I said yes. But they asked me, "Hey, Alex, what if Perth property market went down again? It went down a couple of times in the past." I said to them, "Well, Perth economic structure is changed forever. It's not like before. It's more diversified economy, and people are moving from interstate, from other states and territories to Perth, because there are a lot of jobs in Perth, not necessarily in the mining sector, but as well as other sectors. So the structure has changed." And then people ask me the same question here and here and here and here and here. They always ask me this question, "Alex, should I buy a property in Perth?" My answer was always yes. Some of them some of them believed me, but other people didn't. Anyway, that was their choice. So if you ask me the same question, should you buy a property in Perth now? I would say yes. Okay. These are the three smaller cities. All right. Smaller cities: Hobart, Darwin, and Canberra. Hobart is always it's been on the upward trend. Well, not necessarily up every month. It's up, was down, was up again, and down again. But the overall trend was up. And last month the price increased by 0.3%. It's a good sign. It's a good sign. Well, we do a lot of buyer's agency services for our members, Vision members, and they could buy a property anywhere in Australia because we're national operating business. So we help the Vision members wherever they are. They could live in Sydney, Melbourne, wherever, to buy properties anywhere in Australia. So there could be a lot of combinations. Yeah. And then we started buying Tasmania or Hobart, to be specific, for our members, roughly from less than 6 months, probably 5 months ago. At the time, the market was really quiet. Once the property was put on market, usually it took about 4 open inspections before they got the first offer. Now it's 1 week. Sometimes it's 3 days. It got crazy. It got crazy. If you live in Melbourne, you probably know Hobart's market a little bit better, because geographically, these two cities were really close. And people travel from Melbourne to Hobart, and from Hobart to Melbourne. The funny thing is that if you still remember long enough, when the property market in Perth and in Sydney and Melbourne was not performing well from 2017 to 2020, Hobart was performing exceptionally well. I'm not sure if you remember that. So every city goes in cycles. When Melbourne and Sydney were not good, Hobart was good, and vice versa. All right, and Darwin. Darwin is on the crazy run. still on the same run. It's in the upward trend. I'm not sure how long this cycle is going to last, but I guess it could be ending in the third quarter next year, probably. Just a wild guess. All right, I'll tell you the reason later in this webinar. Okay, Canberra is going up, but it's not going up by much. Last month, it went up by 0.6%. You could see that the stock on the market in Canberra was getting tighter, and the sales activity went up a bit, but it was not as hot as those mid-sized cities, Brisbane, Adelaide, Perth. There's just no comparison. All right, so the market trend, let's give it a summary. Large cities, Sydney and Melbourne, growth were accelerating. And Melbourne outperformed Sydney officially for last month. And for this month, no, I'm not sure. I'm not sure. Okay, let's see the data when it comes out in the beginning of next month. Mid-sized cities, they're all the growth in these three cities are all on accelerating, and Perth was outperforming other two cities. The smaller cities, Hobart, Darwin, and Canberra, they're all up. They're up. Just Hobart is trending up, different. It goes up. It goes up and down, up and down. The trend is up. Okay. Now let's take a look at this chart. That's the 90-day trend till October. Some other people call it rolling 3 months or rolling 90 days. If you give it, if we look at the monthly chart, it goes up and down faster because it fluctuates. But if we use the 90-day rolling 90-day chart, it tends to smooth out the fluctuation. It's easier to see the trend. So if any line is above this zero line, that means it's in the upward cycle. And as you can see, Perth, Brisbane, Adelaide, Sydney, every city is an upward cycle. Okay, those graying circles they mean they represent the exact time that I called the market. So here I called market up, here I called market down, here I called market up, down, up. As you can see, I wasn't successful in guessing the exact bottom or top timing of it, but I guessed at the trend correctly. Well, because I started working on this English side of the business or channel, a YouTube channel, seriously from about 6 months ago. You probably don't know that I called those market point out in the last few years. But anyway, I think I was lucky to call the right at the right time. They all turned out to be correct. All right. Sydney market is at peak. Brisbane, Adelaide, Perth, Darwin are all at peak. Melbourne still 1.4% lower than the last peak, which was in March 22. And Hobart is 8.9% lower than last peak, which was in March 22. And in May 22, that was the last peak of Canberra. It's still 3.5% lower than the last peak. All right, let's take a look at the auction clearance rate. In the meantime, if you guys have any questions, just type in a chat box. I'll answer it. Okay. Which one is it? That's the one. Okay. This is the auction clearance rate for the week ending 2nd of November. It was last week's. Now, the national clearance rate combined capitals is 65.8%. Sydney 66, Melbourne, I'll give you another view. I want you to see the trend. This is for the week ending 2nd of November, and that one is 28th of September. So you can think of it as the table for the auction clearance rate for last month. This is the month before. This is the month before last month. Okay. So this is October, September, August, and July. So if you look at the auction clearance rate in July, August, July, the overall was 68.5%, and then it went up to 69%, and then down a bit to 68%, and then down again, and that's 65%. Okay, so what I can see, oh, by the way, Sydney, 73%, 70%, and 66%. Melbourne, 67%, 64%, and 61%. See, those two cities are losing some clearance rate, just a little bit. Okay. Well, the price is going up, but the clearance rate is going down. What does that mean? That means the sellers expected a lot more than the buyers would like to pay. Right, but there are still a lot of deals going on in the market, but just not as many. Okay, and these two cities are on a quite different path. So see, this is Brisbane, this is Perth. Brisbane was 60%, and then 64%, and then 68%. So the price was up, and the clearance rate was up too. The same thing happens in Perth. What does it mean? These two markets are exceptionally strong, as well as Adelaide. Okay. So the rent trend, I give it a summary. I think it's much easier for us to understand. The house rent in Australia, everywhere, every city, the house rent all went up in October. Unit rent all went up. Adelaide house rent is deaccelerating. It went up, but the speed of the growth was down a bit. And Adelaide Perth unit rent deaccelerating. Okay, what does deaccelerating mean? It's still increasing. The rent is still increasing, but the speed of it is not as fast as before. So it's losing some steam. That's an early indicator of the unit market. I mean the price of the units. If the rent is not that strong, that could indicate that the unit market in Adelaide and Perth won't be as strong in the future. And this one, Adelaide house rent deaccelerating. That means the future Adelaide house market could be losing some energy. All right, okay, but in Adelaide, the price is still going up. Okay, for the gross rental yield in October, the national average is at 3.6%. For those of you who doesn't understand doesn't understand what gross rental yield mean, I'll give it a brief explanation. You calculate the whole year's rental divided by the property price. That's called gross rental yield. Gross means we didn't take the expense into consideration. It's just the income. Okay, so that's the gross rental yield. It's not the net. Net means you've got to take out the interest payment, take out all the holding costs. All right, this is the gross rental yield. National average is at 3.6%. Sydney is the worst, 3%. Darwin is the best, 6.4%. So if you're chasing rental yield in the residential property market, you should buy something in Darwin. But I know Darwin property price is crazy. It's getting crazy. It's been like this for a couple of months, probably almost a year. But I never wanted to buy in Darwin because the size of the city and the potential swing of the price movement. I'd rather buy some sort of like blue chip cities like Sydney. Always wanted to buy in Sydney. Brisbane and Perth are growth cities. Adelaide is good. And then now Hobart is getting up. So I'd rather buy Hobart than Darwin. I'm not sure if you guys agree, but that's just me. I don't direct my Vision members to buy in Darwin at all. I know the price is up, the rental yield is good, but I'm just worrying about the future growth potential and the price potential price change in the future. That's just me. All right, let's give it a summary. National value in October went up by 1.1%. It's the 9th consecutive monthly gain. Growth is accelerating. In total, we've got 6.1% growth for the last year. And the growth rates is going up. So why is the growth? Why is the property market going up? So have you thought about that? What could be the reason? Previously, it was about in February, we've got the first ever rate cut in this cut cycle. And property market started to recover. In May, we've got another cut. That's just after the election. We've got another boost in the property market. And then the trend got really steady. But it's not every city. And then we've got another cut in August. And every city started to grow. Last month and this month, we didn't get a cut. So it's still growing. Why is that? So have you thought about that? Well, a couple of reasons. I think the boost came from the 5% deposit guarantee scheme, which started in the first of last month, October. A lot of people, whether they can afford or cannot afford to buy a property, they tend to use this the 5% deposit scheme because they don't have to pay a mortgage insurance. This lender's mortgage insurance. And that could potentially save them about $20,000. So previously, a lot of people couldn't afford to buy a property. Now they could. So they're buying. They're buying up. What we observed was that the lower to mid price points of the market went up faster than the upper market. The lower to middle quartile of the market recorded the fastest growth. In Q3, the Q3 growth, the lower quartile got 1.2%, middle 1.4%, and upper quartile it's 0.7%. What does it mean for upper? That means, well, it depends on city. In Sydney, I think if the price is over 5 million, I think it's the upper. In Sydney, anywhere between, let's see, 2 million to 5 million, I think that's middle. Any property that's lower than 2 million, I think that's the lower quartile for the houses. Okay. The national rental growth picked up to 0.5% in October. The annual change, we've got annual change of 4.1%, which means if your rental was $1,000 per week, now it's $1,040. Went up a bit. Vacancy rate remained tight across most regions and holding at around 1.4% vacancy rate at national level. It's very, very low. Before the COVID, the average vacancy rate was 3%. It was a balanced market. 3% means a balanced market with choices and price negotiation. If you go out there and wanted to find a place to live, you want to rent a place, you can find a couple of choices, and if you like any property, you can, well, negotiate down the price or negotiate for a better term. That's for 3% vacancy rate. 2% means a very tight market with less choices and no room for negotiation. But 1% or lower than 1%, it's a crazy rental market. Unbelievable rental market. It's very, very tight. No matter how hard you try to find a property, as soon as you pick up the phone and call the agent, they'll tell you it's taken. So that's 1%. Now we're at 1.4%. Just a little bit better than the extreme level. Okay, now it's a complete vendors market. The growth is due to low interest rates, 5% deposit scheme, and we've seen that the dwelling commencement was 9.5% below the decade average in June. I'm going to come to that later. And completion, and then we've got inflation shock. I think I made a video about that. In Q3, we've got inflation. I think I've got a slide for that. I'll come to that later. The outlook of the market, I think, right? I'm guessing, okay? Not a guarantee, not a prediction. It's just a guess, wild guess. Possibly it's the end of the rate cut cycle, possibly. Maybe we'll get another one, maybe not at all. And then we're going to be facing a prolonged period of a pessimistic consumer attitudes. I got a slide for that too. Investors comprise an above average 38% of mortgage demand. So out of 100 residential mortgages, 40% of it was taken by investors as of last month. It's a crazy high rate. It should be at around 20 to 30%, but now it's 40%. So it could be a warning sign or an early warning sign. The housing credit for investors is rising at the fastest pace since 2015. So potentially, we're going to be facing a tighter lending policy down the road. Not sure when, not sure how much, not sure how severe it will be, but it could happen. It could happen. Okay. All right. For future growth, the driver will be industry expansion, jobs, and population. Well, there are a few factors you can consider a growth factor for the housing market. If the interest rate gets down, the borrowing cost is getting down. So people could afford to buy a more expensive property because they got better mortgage terms, lower rate, lower repayment request. That's one. And two, if the government is throwing out some money like this 5% deposit scheme, they will go up. On the supply side, we couldn't solve the housing crisis anytime soon in Australia because we just don't. I'm not even sure we want to build more houses, more properties, because we're not building any. We're not building enough houses now, and it's just impossible to boost the building capacity in a short term because of building material inflation and the wage growth for tradies, as well as the availability of tradies. And then combining the factor such as the government has some large projects, and they wanted to hire good tradies as well, and they're offering a lot of money for that. So for a private developer or a private builder who wants to get their project up and running, they've got to compete with the government on price or on salary. So that's why it's really hard. Now we don't get more government stimulus because we've got one now. And if we don't get any support from the RBA with lower interest rates, then what factors could there be to boost the market? Well, it'll be from the internal factors like industry expansion, like I wrote here, jobs creation, and population. We've got international migration coming to Australia. We've also got interstate migrations. People leave Sydney and Melbourne, and they go to either Brisbane or Perth, and because there are a lot of jobs in Perth, high-paying jobs. So they will get more demand in that market. Okay, anyway, let's keep going. Okay, this is the Q3 CPI shock. We've got a shocking report in the end of last month. So the CPI went up by 3%. It's a trimmed mean CPI. That's the favorite measurement that'll be considered by RBA when they try to decide if they lower the interest rate or keep it steady, or maybe they will increase the rate. But they didn't. They didn't do anything in the last meeting. That was on Tuesday. So the RBA kept the rate unchanged the day before. So the CPI is on the upward trend. It's quite a shock. It's quite a shock. When we get the next rating, which will be in the end of January or Q4 CPI rating, then we'll see if the CPI would continue this upward trend or it's going to go down. You never know. See that one? Goes up and down, up and down. You never know. If the CPI is up or is too hot, then the RBA will tend to not change the current cash rate, or they may think of increase the cash rate, just trying to keep the CPI lower, to give it some pressure. But they can't do it. Why? Because the unemployment is up there. The unemployment is there. Where is that? Okay, that one. The September unemployment, we didn't get the October update. So we still get this September one. The data was out on 16th of last month, still up to date. The unemployment rate went up from 4.3% to 4.5%. It's a significant change. Although we are still at the low level compared to pre-COVID years, but the market, the employment is not as good as before. It's getting worse. The unemployment is getting worse. If the unemployment rate is going up, that means the RBA had some reasons to lower the interest rate, to boost the market, to support the businesses, to hire more people. But they can't do that because the inflation is right there. See this conflicting trend. So I don't know. I don't think Michelle Bullock knows what to do. Anyway, okay. This is really a tough job. In September, building approvals went up. In the housing sector, the month to month, building approvals went up by 0.3%. It's quite normal. But what's shocking me is this number. The non-house building approvals went up by 1.8%. It's really obvious. It's here. It's going up. Well, the housing approval is going up gently, but this one is not that gentle. It goes sharply. It's going up sharply. What does it mean? Does it mean in 1 or 2 years, there will be a lot unit supplies that comes to the market. I know that Brisbane apartments went up in the last 3 years, and the growth rate was actually higher than house price growth rate. But what I'm talking about Brisbane, nowhere else has the same trend, just Brisbane. But if the supply goes up by a lot, then the apartment market may stay there for a while, or maybe the price of it will, I don't know, it could go down a bit and then stay there for a while. So I'm suggesting my Vision members to sell off the apartments that they're holding in Brisbane. Now I give them those advices. Well, it depends on which one, which project they're holding, which property they're holding, and what their entry cost was. But in general, I recommended most of them to see if they should sell, and then put the money somewhere else. Okay. All right. Oh, this is the consumer confidence sentiment. The research is done by Westpac and Melbourne Institute. It's going down. So people are not confident enough to spend. This is the measurement in the consumption sector, like buying daily stuff, or going out to eat, and spend on a new TV or doing some kitchen renovation, that kind of spending. People just don't want to spend. Okay, it's here. If the number is at 90, that means it's the market could go down in consumption. And then, well, you can use this chart to measure how much the people want to buy a property. Well, people are on steroids right now. When they talk about property, they just want to buy one, anyone. Because we've one of our services is buyer's agency. Well, that's only about 30% of our business. I do quite a lot of other things. Well, I'll introduce to you shortly. But we see the trend. We see how it works in the market. If we represent a member as their buyer's agent, so we need to do a lot of research in the market. And when we see a property coming to the market, or even when it's off market, we need to go there, not physically, sometimes physically, check out the property status, doing some numbers, do due diligence, and then we make an offer. We can't do it now, because if we go through the whole process, we can't get it. Usually especially when the property is in Brisbane or Perth, as soon as the property is on the market, it's gonna be under offer in less than 24 hours. We just don't have enough time to do all the work. So we rely on contract clauses. We always put in clauses like finance clause, subject to building inspection, pest control report. Then we get a chance to go in and inspect it with the building inspector. It's really hard now, even for us professional buyers agents. Well, that's about 30% of our business. Okay. This is the financial markets bet on rate cuts. Well, the financial market says there could be no cut in this cycle. If there is one, that will be in June or July next year. But this could change anytime when they see the updated CPI report in the next few months. This could change. But at this stage, they're expecting no rate cuts, or maybe one. Okay, this is the migration number. This is the population number. So I just take a screenshot of part of this report because I want to explain to you something. Now, there are two parts. The upper half of it shows you the net overseas migration by state and territory. The bottom part is the net interstate migration by state and territory. So let's take a look. New South Wales, net overseas migration for a year. That's annual, right? For a year, that's almost 100,000. Victoria, almost 100,000. Queensland, just over 50,000. And WA, over 40,000. South Australia is not that many. There aren't that many overseas migrants going there. And other states and territories got a little bit, but nothing that's comparable to other cities, to New South Wales or Victoria. Now let's take a look at the interstate migration. Let's see, well, overseas migration tend to go to New South Wales and Victoria or Queensland or WA. But where do Aussie go? Where do they go? Or it could be a new migrant who came to Australia, not a new one, a migrant who came to Australia 10 years ago and they became a citizen, and now where would they go? Okay, the interstate. New South Wales is losing 26,000 people to other states every year. Victoria loses some people, about 2,000 of them are going to other states. So where do they go? Queensland and WA. So what can you see? Do you see the trend? The trend is Queensland and WA got a lot of overseas migrations as well as interstate migrations. Okay? That's why my guess is that even if Sydney and Melbourne goes down, these two states will go up, as in property price, for a while. Those two states will be stronger in this cycle, much stronger than Sydney and Melbourne. That's my guess. All right. Because of population. Remember what I told you guys? If there are no cuts, that's one of the ways to stimulate the market on the demand side. And the other one is government stimulus, but we don't see any new stimulus out. Then we can only rely on industry expansion, jobs creation, and population, the movement of it. So these three things are essentially just people. Whichever state or territory gets more people, then the property price there will go up more. It's very simple. So Queensland and WA would be stronger than New South Wales and Victoria in the foreseeable future. Okay. All right, our opinion. Market will trend upwards because of lower interest rates, larger borrowing capacity, limited supply, higher demand, more immigrants and interstate migrants, and 5% deposit scheme from 1st of October. But we still got two uncertainties. One is inflation. We're waiting for the next quarterly report. It's going to be released. The fourth quarter of this year's report will be released in the end of January, or could be the beginning of February. That's why a lot of banks expect the RBA to lower interest rate one last time in this cycle, either in February next year or March, because by then they would have already seen the fourth quarter CPI report. Unemployment rate is another uncertainty. And our forecast is that the upward trend will gradually lose momentum. And the current cycle could continue to Q3 2026. And I would like to keep my guess unchanged. And the guess, I made the guess, or you can call it forecast, whatever you want to say, in August this year. It was 2 or 3 months ago. I made this forecast. So I'll just keep it. I don't see a reason to change it. Queensland, WA is your best bet for growth. If you want to make money quickly. New South Wales and Victoria are in the recovery phase. If you hold the properties long term, either in New South Wales or Victoria, maybe the short term performance would lag the other two states, but in the long run, it's still very good, very good. As I said all the time, that's just my opinion. If you want to play the residential property investment game in Australia, you better play long term. If you want to play short term, go to the share market. That's number one. Number two, if you don't want to have any loan, if you don't want to take any mortgage and you still want to invest, don't invest in Australian property, invest in the share market. Without leverage, property's growth is worse than share. With leverage, property outperforms share by a large margin. All right. Okay. Any questions so far? No questions. Oh, you guys all understand what I talk about. Is that a good thing? I don't know. All right. I want to talk a little bit about how to invest in property. This is not I'm not talking about the market anymore. I'm talking about how you should think. It's kind of what I call a property investment theory. That's my theory and what I use to make judgment on which suburb and what time, under what kind of situations, buying what kind of properties. I follow those rules. Okay, I'll share with you. I never shared it with anyone. Okay, we follow this investment framework we created. I call it Vision. My product is all called Vision something. Okay, Vision membership, Vision club, Vision buyers agency. So I call it Vision all-weather investment. That indicates that we wanted to create a portfolio for our members so that they will always make money regardless of what kind of market condition there is. So that's why I call it all-weather investment. That includes all Australia. We cover everywhere in Australia. We cover all types of properties, including apartments, townhouses, units, and standalone houses. It could be new properties. It could be old properties. And I don't think anyone or any company in Australia can do that at this stage. They're either buyers agents who only work on old properties, or they're project marketers who only work on new properties. But they could be limited. They could limit their service in a specific city, like just Melbourne local buyers agent, something like that. But we do everything. Okay, everywhere, any type of property, because we believe every member has their own needs. We want to meet every member's needs. That's why we need to include all Australia, all types. Number three, all smart selection. We use quite a few things nowadays to make sure that our decision is correct. So the first step is that we do data research. Do I have that? No. Do I have it? No. Okay. Next time I'll bring it to you. So first step for us to find a suburb or find a property is to do a data research. We've got our own data platform, and actually I'm the head strategist over there. I teach other buyers agents how to do data research. On there, we use that platform. We can see up to 8,600 suburbs data all the way back to 30 years ago. So if we type in the parameters that are suitable to a specific member's needs, we can screen the suburbs in probably a minute. We'll find a suitable one, and then we're going to use the AI tool to verify the basics. Now we're in the AI era. Previously, when we tried to verify those suburbs details, Normally, we could only do it manually, and it took a lot of time. Now it doesn't take that much time. We've developed these AI tools. Actually, there were 3 tools we're using. The whole process, the verifying the basics process, now takes about 3 minutes. Previously, it could be half a day. Now 3 minutes. That's why we can squeeze all the buying process into about 2 weeks. And then the third step is for our strategists to verify everything and make decision. So for new builds, we focus on planning, qualified supply pipelines, future developments, and due diligence for developers and builders. That's exactly what you should be doing if you're going to do it by yourself. And then part of the all-weather investment framework, we've got this all-entity strategy. Well, to hold a property, you can use your own name to hold it. There are good things and bad things. Good things could be, well, if you hold the property under your own name, you enjoy 50% capital gains tax discount. And then you can deduct the interest rate against your tax, personal income tax. You can use negative gearing, a lot of things. But, well, you don't get the benefit of holding the property in other structures. There could be company structure, there could be family trust structure, there could be self-managed fund structure. Every structure has their own benefits and bad things. Good things and bad things exist in every structure. So different people we use different structures to hold their properties, and then we form this whole portfolio. So in the same portfolio, property investment portfolio, will help the members to create different structures to hold different kind of properties in different states, territories, with different types. You get the picture. All cycle, yes, all cycle. Well, think about this. If the property market in Melbourne is going down, while the Queensland market is going up, which is essentially what happened in the last few months, you can buy a property in Queensland, right? And then when Melbourne recovers, you buy another one in Melbourne. But the chances are when you're holding these 2 properties, one state property market goes up, the other one goes down. So it's balanced. Rather than holding like 5 properties all in Melbourne and all apartments, all in Docklands, if the price goes up, you're a winner. If the price goes down or stays flat for 10 years, which was what happened in Melbourne Docklands apartments, then you're a big loser. So a lot of risk in there. So we tend to buy, helping our members to buy properties in different cities in different cycles. All process, okay. This is part of all-weather investment. Our one-stop property investment portfolio management, that's the name of our service, a bit long. This service integrates all the full service from strategy to on-the-ground execution. We give you strategy and then we go out and do it for you. So it starts from define financial goals and then lending structure, city, precinct, project due diligence, property selection, legal and settlement, building inspection, defects rectification, leasing and day-to-day management. Tax compliance, we do that too. Annual review, we do that. And financial planning, we also do that. So that's why I call it as one-stop service. All right. All right. Now, that's the all-weather investment framework that we developed and we use for all of our membership. We use this investment strategy, investment framework on all cases of our members. Now, I want to talk about another thing. Well, there are two kinds of investment styles. Uh, in general, the one style is called value investing. I made that up. I made that up. Well, actually, I created it. No, hold on. I didn't create it. I borrowed the idea from share investment. But actually, it fits really well in Australian residential property investment, and we've been using this framework for a while. The first kind of investment is called value investing. And then if we're using value investing, then the reason for it is that we are chasing steady appreciation, steady price growth. We buy quality homes in livable, well-served areas, and we keep a margin of safety, which means we enter the market at bottoms, or not the exact bottom. I told you guys I can't guess the exact bottoms, but around there. Okay, and we enter the market at bottoms or early upswings to build a value moat. Because when we enter, the price will go up in a few months, and then you feel safe, you feel comfortable. That's what I call a margin of safety, and hold for the long term to harness the compounding and minimize taxes and costs. I don't prefer my members to sell a residential property in less than 5 years and buy another one because I don't want to pay taxes to the government. Why would I pay stamp duty every 2 years to the government? I don't want to do that. And every time when you sell a property, there's a lot of it's really time consuming. You've got to arrange the tenants, you've got to do staging, and from the time you have this idea of selling a property until the time the property settles and you get the money, it could take anywhere between 3 months to half a year, maybe 9 months if you're not lucky. Okay, so I wouldn't want to do that. I want to do all kinds of research and make sure this decision of buying the property is correct, and I'll just leave it there and go for holiday. That's my style. And then stay within your circle of competence. What does it mean? If you know it, then you do it. If you don't know it, don't worry about it. Okay, it's very simple. We want simple, repeatable, and passive strategies over complex active bets. What does active mean? If you buy a large land with crappy house and you want to do a renovation or knock down a rebuild or even small development, subdivision, it's not investment, it's a business. If you don't have the time, you don't have the talent, you don't know building industry, I don't suggest you to do it. It's a full-time job. Okay, it's complex. You could lose money, or you can make money. You could also lose money. So I always want help our members to follow this principle that's called stay within your circle of competence. Just go with simple, repeatable, and passive strategy. Okay, that's buy a single property, hold there, and don't sell. That's the simplest one, and it works. So that's value investing. The second kind that we're implementing to our all-weather investment strategies is called growth investing. The reason why we want to use it is that we're chasing accelerated appreciation. We want to get money quickly. Value investing, that means we want steady appreciation, but growth investing, we want accelerated appreciation. It's a bit harder. Oh, there's a question. Okay, hold on. Chris asked me a question. Do you see tax changes targeting property investors and bank lending rules affect price movements in the future? I do. Macquarie Bank is restricting lending towards trust structures. Yes, I made a video about that, and I put it out yesterday. Please take a look. It will affect the market, but not yet, because whichever bank could do family trust lending and company lending are still in the business. They're still doing it. It's just Macquarie. Macquarie is out, but other banks are still there. I just need to spend a little bit more time in gathering your documents, doing the application. It takes 24 hours for Macquarie, but it could take a week or a month for other banks. And then you get less favorable interest rates with other banks and less favorable terms, and you still can't do it. Okay. All right. Okay. So for growth investing, follow the policy in real time. Follow the planning. Okay. Pre-position in decade-long upgrade corridors, which means if the government has a huge infrastructure plan, or they want to have they have a master plan to build a mini city, or they have a lot of highway building in the pipeline, or they have an industry park, something like that, then you need to go there. Because once you buy in it, well, chances are you're going to buy a house, land package, or apartments, or anything that's new in the developing suburbs. Then if you buy early in those developing suburbs, then chances are you're going to get accelerated growth, right? So two kinds of strategies. Or you can try to find an undervalued suburb. For example, you can target long suppressed values. You need to find those suburbs where the price didn't move for quite a while, but it's still fundamentally a good suburb. You need to buy in before the breakout. It's really hard. I'm telling you, it's really hard. Even for me, it's hard. It's like predicting the future from the data you have. Okay. Riding the development cycle. Enter early in the middle of the development period, and then later take profits, meaning selling, or convert it to long-term value holds. And I'm referring to a developing suburb. Say there's a 20 years developing plan, and a lot of developers go into the suburb and try to do their own developments. Say 5,000 properties in total, 20 years of plan. You get in the first 5 years. When you see nothing in the suburb, it could be still bushes. That's the best time, because no one see the value, you do, and then chances are you get better than average value return. Okay, if you see value others don't see, you get the value others don't get. It's that simple. All right, and then if you go in to this developing suburbs in the first 5 years, say it's 20 years plan, and then hold it till the 20th year, and then you face two choices: either sell it and use the money elsewhere, or keep the property. But if you keep the property, the growth in the future will be average, because that's already established suburb. Yeah. You guys tired? I'm talking about theory. I shouldn't. It's quite boring. If you feel boring, let me know. If you feel boring, let me know. All right. This is all the thinking that I did behind my business, behind my videos, and behind my own investment decisions. Just want to share with you. If you don't want to listen to this, just let me know. Okay. Okay, and then I'll share a little bit about the exact rules that I follow. I've got two sets of rules. If you want, I could take a screenshot, but I don't think you need, because I'm going to keep this video on YouTube. I follow two sets of rules. The first is called Golden 11 Rules. That helps me to read the market trend. Okay. I actively monitor all of this, like population flow, building approvals, completions, RBA cash rate, etc., including existing home supply, auction clearance rate, global economy, and geopolitics. That's really important, actually. Okay, so that's how I monitor the market and how I guess the trend of the market. And then the second set of rules is more specific. It's called Golden 21 Rules. Pinpoint the quality, suburbs, and properties. That's for me that helps me to choose a good suburb and good property. So I need to find a suburb that has fast population growth, high household incomes, well-educated population, diverse demographics, well-developed, etc., etc., etc. Okay, all of this. I think I should make a video about that. What do you guys think? To explain these two sets of rules. If you know how to do it, you're going to be an expert too. On the Chinese side, this is actually a paid course. I charge 3,800 for that. I should make a video? Okay. All right. Okay. All right. We don't have much time to explain this. I still have some slides to go through. So yeah, I'll make a video about that. So our services. Vision membership is our VIP service. That's a one-stop property investment service. We build a tailored portfolio that's roughly 5 to 8 properties for our members, and we help them to achieve financial freedom. And we want them to actually retire early, not necessarily retiring, but retirement. The meaning of retirement is different to different people. Some people think retirement means change your job, change from the current job to something they like. That's called retirement. For other people, retirement means work less. And for the rest of them, retirement means retirement, doing nothing. I'm not sure which one you are, but I'm the one who never wants to retire. I could travel and work, but retirement for me, I tried it once. I retired for about less than a year back in 2017. I think I got enough money and wanted to try to retire and see how it feels. It felt terrible. I enjoyed myself in the first 3 months, maybe less than 6 months. And I went to other countries. I traveled around the world and tried to do different things, tried to play golf, and took a lot of photos. And actually, I still have that photography website and channel. And then I felt boring. And I came back to work. I can't retire. Anyway. All right, this testimonials we've got. We've got a brochure for a Vision membership. We're running out of time, so I want to introduce to you about this. But if you're interested in hiring us or joining the membership to build your investment portfolio, please go to our website. And I'll actually type it in the chat box. Just go to our website and try to book a 15-minute discovery consultation. Or you can just book this 30-minute Zoom session with our strategist to go through the membership and see if it's suitable to you. All right. All right. There's still. Oh, yeah. Well, I used to do this global economics section while focusing on US economy, but there's not much I can say. Reason is that it's because U.S. government shut down. It's over 30 days, so I don't have any data. So I won't come to that part for this webinar. There's nothing to say. I don't know. No one knows. All right. We're hiring property investment strategists. If you are in the property investment world, or you're a real estate agent, you've helped clients to sell or buy any properties, you've got experience, and you've got a good heart, you're more than welcome to join us. We pay good money. All right. Go to our website, or you can send an email to info@oceanpropertystrategy.com. Okay, now let's go to the Q&A session. Do you guys have any questions? Any questions? You get to ask me anything now. Any questions? Oh, no questions? That's great. That's great. Any questions? No? We've got actually 3 services. The VIP service is Vision Membership. We're happy to build portfolio and retire early. You can start by booking a free 30-minute discovery session. Our second service is Vision Membership, Vision Buys Agent. Well, it's a simple service. You tell me what you want, I go out and buy it for you. You pay me a commission. Very simple. We operate nationally. We can buy a property for you anywhere in Australia for a flat fee, not much. You can start by booking a free 30-minute discovery session as well. And we manage Airbnb rentals, short-term rentals. We've got a team in Melbourne of 12 staff managing 220 properties all across Australia. Initially, we started that business for our members because our members buy properties. It could be anywhere. And sometimes they just want to increase their rental yield. But obviously, renting it out long-term cannot achieve that purpose. So we created this service to serve them. But now the system, it's set up and the business is right there. So we open up for anyone who's not a member. Okay. All right. Okay, I think that's pretty much it. Since you guys don't have any questions, I'll call it a day. Thank you very much for your company for the last 80 minutes. Actually, it's about 90 minutes. Oh, 80 minutes. Okay. And then next month we won't have a webinar because that's in December. I'll send out a bulk email to all of you, to whoever subscribe to my channel or subscribe to my newsletters, and then you guys will know when the next webinar is. In the meantime, if you want to ask anything about property investment, you can go to our website and book a 15-minute free consultation, and you get to ask any questions. You get to ask our strategists any questions about property investment on the phone. All right, so free. Thanks again, and I'm signing out. Bye. Thanks, Brad.